Hey traders, Tom Gentile here. I know it's been a while. I apologize, but I'm back. I'm back with videos that are short, concise, and with information that you're likely not to find anywhere else. So that being said, happy to be back. Let's get started. All right, so let me first state that I'm not just an options trader. That'd be crazy. In fact, if you had a look at my portfolio, there's a lot more than just options to it. There's long-term holdings. There's conservative money at work in stocks as well as ETFs. So when it comes to options, however, I'm typically on the sell side. It's really because I love the premium and I love the probabilities of selling. So that being said, what I decided to do for my first video back is have a look at the 3,000 optionable stocks that are out there that currently pay dividends. So I'm not so much focused on the actual dividend amounts as much as I am the dividend yield, because that gives me an ROI on the stock price and what I originally entered a trade for. So take a look at this list of the top 10 dividends on basically every optionable stock that's out there. Wow. I mean, these are crazy. But the craziest one up there is number one, which is Renren. Now, upon first looking at this chart, you might get excited saying, wow, is that correct? A 2,500% dividend yield paying forward? Well, folks, I mean, looking at that one as well as the rest of the top 10 on this list, I mean, it made the hair on the back of my neck go up, because it's literally impossible to receive more dividend in a year than the stock price is worth. So let's dive a bit deeper into this, shall we? So take a look at this chart of Renren. I mean, it shows right now it's trading at $1.26, but look where it was in December, all right? Just around earnings time. It was trading at $34 a share, okay? Upon a little bit of investigative work, what we found is that, and many of you might already know this, this is kind of a corrupt company. I mean, it was based in Beijing, then it had a shell company. It was formed in the Caymans, and the deeper we dug, the worse that it ended up getting. Problem is that with reporting systems the way they are, for dividends that haven't updated that much, even there's a huge change in the company, it makes their dividend yield look astronomical. So in a nutshell, it's not real, all right? So even for the rest of those top 10, look a little crazy, because when you see dividend yield in high double digits, it can be anything from reporting errors. It could even be a reverse stock split where the dividends haven't been updated. So it might be a bad number until maybe a minimum of a quarter to as much as a year of dividend reporting comes out in order for that to correct itself, okay? So rule number one, when it comes to looking for dividends, don't believe what you see, right? Now, from there, what I did was I went ahead and stripped down my 3,000 optionable stocks. I basically took the top 10% of these by volume and then reran them. And what I did was I took that list and I reran it to see which ones were trading on the top side, which were the most bullish of the 300 top liquid stocks that trade dividends. Here's what I came up with. Here's the top 5. iShares MCSI Brazil Index came in at number 1. Energy Transfer LP, number 2. UWM Holdings, number 3. ExxonMobil, number 4. Cisco Systems, number 5. Now, take a look at those top 3. You've got a 7%er in at number 3. You've got a 9.5% at number 2. And the EWZ came in at number 1 with a forward dividend yield of 12.94%. That's projecting out into 2023. All right. So from here, do I want to just take what I'm seeing right now and just move on? No. I mean, upon first glance, EWZ does look kind of juicy, but do some homework. And what you'll find out is that EWZ actually paid out these kind of dividends in the past, and their trailing growth has been quite well. In fact, what you can see here is it paid out 11.24% last year, annual dividend of $3.52. Last dividend date was December 13th, 2022. The payout ratio was above 66%, and the dividend growth was double digits at over 27%. So rule number 2 is check multiple sources, which we did. Now, just buying this ETF, for instance, and just buying 100 shares, for instance, going to cost you $31 a share, roughly at $3,100 for 100 shares. Now you're looking for dividend yield. So your potential dividend yield, if you were to key it in at $3.52, if that actually pays out over the next year, that's going to lower your overall cost in the position. Now I say potential because there's always risk that the dividend payout could change. There's also risk that the ETF could move lower from here as well. So rule number 3 is look for alternative strategies to help cut your risk. Now, is there a way to increase dividend yield and at the same time, decrease the risk of owning the stock or the ETF? Well, guess what? There is. And it's called options. Now, the only option we can do to ensure we still get a dividend and yet at the same time be able to cut our risk is what's called a covered call. A covered call is when you buy for every 100 shares of stock or ETF you own, you write a near money option against it to bring in yield. And that near money option can be written a month, 3 months, a year, or even more to expiration. And so when you write that option, you sell that option, that premium is yours to keep. That lowers your cost, that lowers your risk, that lowers your break even on the trade. So here's an example using EWZ. Now, if we were long 100 shares of EWZ at $3,100 or $31 a share, that's $3,100. Selling an EWZ January 2024 31 call, recently traded around $3 per contract, that means you're going to bring in $300, which brings the total cost of this trade down to $2,800. So think about this. You're selling a 7-month call against the ETF. You're bringing in 9% in options premium that will reduce the overall position. You also reduce your break even on the trade to around $28 a share. Add the projected 11%, give or take, dividend, and you got yourself a 20% return on the stock if it goes up, even if it goes sideways, and you got yourself 20% protection to the downside. Now, like we said before, there's a lot of variables in capturing this 20%. Stock price is a variable. Potential dividend payout is another variable. But you get guaranteed income by selling the calls against the stock you own. That's yours to keep, whether the stock goes up, down, or sideways. And guess what? When 2024 comes around, we could do it all over again. We could roll that covered call position out to a future month, therefore bringing in even future option income against the stock or ETF that we own. So in closing, Viva Brazil, and I'll see you on the next video.